goal of the Federal Reserve is to see that the labor market achieves full employment and prices are rising, but only modestly. The Fed has had an extremely accommodative policy stance between buying bonds to lower long-term rates and keeping short-term rates near zero. What do you think the timing looks like for the Fed to come off this easing monetary policy?
Yeah, tapering the bond buying, the quantitative easing is definitely front and center. Just to go back to fourth quarter of 2019 for a second, the Fed's goals of achieving inflation of 2% over the long run and achieving full employment or having an unemployment rate, not too far from where it was back in December of 2019, which is 3.5%. Ultimately, they're going to use their tools like quantitative easing, buying bonds, mortgage-backed securities, and treasuries to help lower long-term rates, to help stimulate the economy, as well as lowering short-term interest rates to help stimulate the economy on the other end of the yield curve. And so Jerome Powell, chairman of the Federal Reserve, he's been very sensitive about the messaging as to when the Federal Reserve may start to do tapering to the balance sheet, and so not necessarily buying nearly as many bonds as they once were, and eventually get that down to not buying any at all at some point in time. And so the taper tantrum back in 2013, which is around this time actually, it was in the summer, was really the result of catching the market by surprise that they would start not buying nearly as many bonds. And so the FOMC, the Federal Open Market Committee, that makes these decisions, has explicitly said that they don't want the taper tantrum to occur. They're literally using those words, and so they've been extremely careful with messaging. And so, again, taking a step back a bit, if the economy is getting back on its feet as it is, and we expect GDP for this quarter, for the second quarter that is, to potentially get close to 10%, which is about 1.5% more than where it was in the fourth quarter of 2019. It definitely is a good case for the Fed to begin tapering these purchases and not nearly have as accommodative monetary policy. And so while the June meeting that concluded just a couple of weeks ago really didn't offer much new information about tapering, it did give us some insight into how the committee actually views inflation. And he acknowledged that the FOMC has been talking about tapering. So again, trying to signal a little bit that we're getting a little closer here. But it made it clear that reaching the standard of substantial further progress is still a ways away, end quote. He also added that the FOMC will continue to assess the economy's progress in coming meetings. And ultimately, I think the first hint that we'll see about tapering could come in August or September of this year, followed by some details about issues such as the pace in November and some guidance about how quickly they intend on on tapering, and then a formal announcement at the December meeting beginning the tapering process in 2022. And so, if you look at the Fed meeting minutes, you look at the we call them dot plots, I'm sure you hear in the financial media, it seems to me that this is consensus amongst many of the participants. And so, again, it's highly unlikely that we'll see the FOMC surprise the markets in a hawkish direction on tapering. But the risks do lean towards an earlier start, both because of how well the economy has been performing of late, but also due to the threat that we've seen with inflation and the report that we just had earlier this week. But I don't think it's necessarily going to come as soon. And while I guess there is a threat, it will probably be sooner rather than later. I think it's highly unlikely, largely due to the fact that until there's just one more employment report before their next meeting, and I think in Fed typical Fed nature, they'd really like to see one or two more, especially given how noisy and unpredictable the data has been recently, especially in the labor market. But raising rates is still a long ways away. Probably will be a 2022 conversation later in the year about when in 2023. There's quite a few participants in the FOMC who think it could be possibly 2024. But ultimately, it's going to depend on what Chris said, which is the full employment and having inflation average over time 2%, which obviously it's much higher currently given the most recent report. So I think chances of a Fed rate hike before middle of 2023 is only about 50%. But again, the labor market and inflation will help determine that. And so, as a result of this accommodative monetary policy, global liquidity has been abundant in the second quarter as a result of all this policy. As to be expected, we saw central banks inject $1.5 trillion in incremental liquidity into the financial system. And this backdrop ultimately supported markets, both stocks and bonds, and seeing the bond market supply and demand dynamics ultimately pushing down bond yields and allowing the bond market to recover after the sharp sell-off that we saw in the first quarter quite a bit. So ultimately, I think the Fed's actions and the speed and some of the economic data that would potentially force the Fed's hand could potentially bring some of the market volatility in the stock market and bond market later this year, and will be likely the most, I think, probable cause for a pullback.